So, as 2025 is wrapping up, there's really one story that has just taken over the entire NFT space. The SEC, the US Securities and Exchange Commission, has finally turned its attention to NFTs. And man, this move has sent ripples through everything, completely changing the game for creators and collectors. So today, we're going to break down exactly what this scrutiny means for the market, and way more importantly, what it all means for you. But, before we jump into the big market trends, let's make this personal for a second. Go ahead, think about your own collection. Is it possible that the NFT you bought, the one you're holding on to right now, could actually be considered an unregistered security? It's kind of a shocking question, right? But it's at the absolute heart of everything we're about to dive into. So, what even triggered this whole regulatory spotlight in the first place? Well, throughout 2025, the SEC has been looking really closely at the language NFT projects are using. They're trying to answer this one critical question. When does a digital collectible stop being a collectible and cross the line into being a financial investment? And this wasn't just some warning shot across the bow. Nope. The SEC launched actual, formal investigations into several really high-profile NFT creators. And just like that, for so many people in this space, the abstract risk of regulation became a very concrete reality. It forced everyone from artists to collectors to start paying some serious attention. Okay, so let's get into the nitty-gritty of this crackdown. What exactly was the SEC looking for, and what kind of actions did they take? To really get it, we've got to first define the one key legal term that this whole thing hinges on. And that term is unregistered security. Look, in simple terms, if you sell an asset and you promise future profit that depends on your efforts as the issuer, the SEC sees that as a security, and it has to be registered. The big problem was a whole lot of NFT marketing started to sound suspiciously like an investment pitch, Buy this, it's going to go to the moon, that kind of thing. So, which projects actually ended up in the SEC's crosshairs? Well, they tended to have a few things in common. First, they made really explicit promises that the NFT's value was going to go up. Second, many of them offered staking rewards, which is kind of like earning interest just for holding the NFT. Third, they were creating fractionalized NFTs, where you're basically dividing up ownership just like shares of a stock. And all of this was often wrapped up in these vague but super exciting promises about future growth. And the fallout, wow, it was significant. We are not talking about a little slap on the wrist here. Creators got hit with massive fines, they faced these long, drawn-out lawsuits, and in some cases, they were even ordered to refund every dollar back to their initial investors. This sent a really clear message. The rules of the road were finally being enforced. But hey, this wasn't just a problem for the people making the projects. Oh no. The ripple effects hit collectors and investors directly, right where it hurts, in the value of the assets they were holding. The market's reaction was immediate, and it was pretty telling. As soon as news of SEC action broke, you saw this clear split. The non-compliant projects, the ones built on pure hype, their prices just plummeted, fell right off a cliff. But in contrast, projects that had clear utility and were focused on doing things by the book, their value held steady. It was a real flight to quality. And this really highlights the new divide in the market. On one side, you have these compliant projects. They're defined by having clear utility, transparent tokenomics, which are just the rules for their digital assets. And this approach builds market confidence. But on the other side, you've got the non-compliant projects, built on vague promises and hype, which just creates tons of risk and basically invites that potential security label. But all of this upheaval, it's not just about punishment. It's really about evolution. These events have basically created a new set of rules, some unwritten, some written, for what it takes to actually succeed and survive in the NFT market. This right here is the path to a sustainable ecosystem. Which brings us to what I'm calling the new compliance checklist for any successful project. Number 1, transparency is everything. You have to be crystal clear about the project's real-world utility. Number 2, legal compliance is non-negotiable now. And third, you need clear tokenomics that define how the asset works without promising speculative profits. So if you take just one thing away from all this, let it be this. The NFT space is growing up. The whole Wild West era is fading fast. Now, being legally compliant is just as critical to a project's success as the quality of the art or how useful its utility is. And that brings us to the bigger picture. It's so easy to see regulation as this negative thing, something that just stifles creativity. But what 2025 has really shown us is that this scrutiny is actually a signal of a maturing market and one that's creating massive new opportunities. Because these investigations, they're not really just about the penalties, they are a signal. They're telling the entire financial world, especially the big institutions, that the NFT market is establishing rules and becoming a much safer place for serious capital. This regulatory clarity is exactly what the space needed to unlock major partnerships and really drive mainstream adoption. So I'll leave you with this final thought. As the market keeps maturing and professionalizing, what does this new, compliant, institutional-grade future for NFTs actually look like for you? It doesn't matter if you're a creator, a collector, or just watching from the sidelines. The landscape is changing for sure, but the opportunities, they're just getting started.
Subscribe and visit Web3 Newswire for more updates on ETFs.